you're never really too sure what it's going to be. You just, you like the blood in the streets, and like you're showing in your chart, uncertainty, concern, volatility. And to me, historically, that has been the time to buy. Yeah, maybe there's another 5 to 10% down, but I'm less concerned about that. And I'm more concerned about the next 20, 30% up over the next 1 to 3 years, if you know what I'm saying.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome to this episode of The Bull on Wall Street. Jim Worden, Chief Investment Officer, Wealth Consulting Group. I am privileged to be joined by my co-host, Talley Leger, Chief Market Strategist. So it's just the two of us today, Talley.
How you doing, Jim?
I'm doing good. How are you? Did you have a good Easter?
I did. We hosted the Outlaws here, and I broke my back in the yard. The yard is open here on the Jersey Shore.
Yeah. Oh no! What were you cooking?
Well, the wife, she was doing the cooking. I was out in the yard, doing the cleanup after winter. But
no,
it's worth
winter
it.
Cleanup.
Yeah. We're not like you. You have a paid gardener. I'm the slave labor here.
Well, so I was out in Hawaii. We, our son graduated from college, and so
Congrats.
visited
That's
with him. Great. And I'll tell you what, it was pretty wild week, right? Because we were at one point, my wife and I were on this sunset dinner cruise off the Napali coast of Kauai. And the water was like glass.
Oh, yeah.
No waves, big, beautiful rainbow. It was as calm as could be. It was just perfect.
That's wonderful.
And then later that night, the worst thunderstorm I have ever been through in Hawaii.
Did that disrupt?
We had a lightning bolt that struck right outside our condo.
Oh my God!
It sounded like an explosion.
I thought we went
from very calm, very calm to wild and crazy. And I felt like this is kind of like the market right now.
Yeah. That's funny. Well, it's good to be on. I was thinking about you because I know we celebrated in Vegas as a firm just a couple weeks ago, but you won a couple of awards. Now I got to call you Jim Worden.
No need.
Yeah. But tell me, tell us all about those two awards that you won recently. That's great.
Well, I appreciate it. So the one with Wealth and Consulting Group was Employee of the Year. That was fantastic. But I will give full credit to the team, including you, everyone on the investment committee, the investment department, the traders. That was really, you guys make me shine better.
Well, you're too kind. I've only been here for 6-8 months, so it's too soon.
Well, you can get partial credit for that. You get partial credit. Yeah. So that was that award. And then I was on this CIO, Chief Investment Officer list for Markets Group. And they highlighted 39 private wealth CIOs.
And you were in good company on that one, I saw.
Yeah, some really, really big firms there.
That's awesome. Yeah. Oh, that's great for the team.
And you've been busy too. You've been on Bloomberg Radio. You've been a lot of places.
Yeah, well, that's part of the gig. As you know, you're running the investments, and I do my part to sit on the ISC with you and the rest, and give you good ideas. But I've got to do my part to kind of spread the word and raise the profile and the awareness of what we're doing at WCG.
Boy, you're doing a really good job of it. And I saw you were on with Charles Payne, Fox Business. That was a great segment, by the way.
Thank
Really
you.
good.
And it's funny you say that because, this is hat tip to WCG and Jimmy Lee, our fearless leader. I've actually never been on Fox Business before until that segment. So that was really fun.
That's awesome. Well, someday I hope to be in the studio. I've done a couple segments with them, with a few of them, but I feel it's always better to be in the studio in person, right?
It really is. It's much more impactful, and you're having a conversation face to face, and the chemistry is I think it's better. But Jim, I wanted to ask you because, and this is all great backdrop, and as I said, I've only been at the firm. It's been less than a year, maybe even closer to 8 months or something. But I was pleasantly surprised by how quickly you and I really started getting onto the same page, almost by accident, because I know Jimmy's trying to create this diversity of thought culture, which is great. But I think one of the things I appreciate about you is, when it comes to the macro and the fundamental, the quant, even some of the behavioral stuff, we see the world through a similar prism. And I think that really helps us kind of sync up. But I also want to say what I appreciate about you is the differences, and we can celebrate those too. That's kind of to Jimmy's point.
Oh,
And
absolutely.
Right?
Yeah.
That gets me to the stock picking, because that's something that I don't do. And I wanted to kind of pick your brain. We can come back to the macro all day, as we always do. But I was talking to Adam Parker last week about this stuff, and I'm sorry you missed that one because you were on your way to
traveling.
Hawaii,
yeah, no worries.
right? As you just said. But let's talk a bit about factors. Like, what are you thinking here about factors? I know quality was probably a great place to be over the past 12 months, but that seems to have changed right here. Like, where are you coming out when you're running your screens? What kind of like factors and companies are you looking at right here in your process? And I would point to the high beta trade, because that is so bombed out right now. We're never really sure of the precise catalyst, but it's like, our spider senses are tingling and something has really changed. Is it time for that trade? What are you thinking? Weigh in here.
Those are really, really good questions. So, I mean, when I think about the process and of course, every person, every shop that has their process, they're always looking to improve that, to fine tune it. It's most often it's not reinventing it, but fine tuning it here and there. And, based on conditions, based on new information and new ways to gather information and analyze information. So all of those things kind of come into play. But yeah, so we want to own all of the factors, right? So we want to own quality, we want to own value, momentum, trend, low volatility. We want to own all of those now at different points in time. Based on market conditions, based on economic conditions, we're going to have a little bit more of some factor exposures than another, but we want to generally we force ourselves to own all of them just because, we don't have a crystal ball. We don't know exactly what's going to happen.
You're playing with the weights, basically.
Right. But we adjust the weights and we constrain ourselves. Well, we're not going to have too much in certain types of trades that are all moving together. We don't want that, right. But we do want to participate, where momentum is working, or where value is working. But quality is one that, this typically is a factor that does well when we have drawdowns. But
this time,
right, this is not like one of those times where it's really doing great.
Right.
With the drawdowns.
Yes, it's got to be related to technology, and tech.
Yeah.
For those who are unaware, is the most internationally exposed sector of the market. So it's amazing how the sector performance has changed. So utilities, the most domestically focused US sector is like number 2 in the performance pole position, and tech is what, second to worst year to date?
Yeah, something like that. I mean, you could look at it every 20 minutes and it may be different, right?
Right. Well,
But there is a connection between the utilities and the technology too, and so we like some of those names.
yeah.
Some of those names that are going to provide the energy for technology.
Yes.
And so,
Electrification.
yeah, there's a lot of different things that are kind of happening underneath the hood here. The other thing is that you would think some companies that would not do well because of trade and because of tariffs, because of consumers, would just be getting killed, and they're not. So, like, for example, we own Adidas is an example of just one company of many that has behaved well, reasonably well, compared to what you would think it would have done with
Right.
trade and tariffs and things like that.
So let's kind of come up. We started at the company and factor level. Let's talk a little bit about sectors and style. And I don't know about you, but personally, for me, it's tough just thinking about my own personal accounts to really have conviction on style right here because of all the disruptions surrounding tariffs and the trade wars. But like, what should we be thinking? What are you thinking about sectors and style in this kind of operating climate? How are you navigating the tariffs? I guess I'll put it out there the way I framed it in some of my conversations recently is, is there any merit to the view that financials, those are services, right? This is a finance-based economy. It's mostly services. Should they do okay in a service economy like this? Bearing in mind that the tariffs and the trade wars, that's a goods related concept. Or so that really, that's the value thing that you were talking about when it comes to style. Or on the growth side, has tech just gotten so hammered recently that it's a screaming buy, and forget the catalyst, just plug your nose and don't even look at your statement for a couple of years?
Well, I like both, right? So, I mean, they both fit.
Yeah.
Financials, I like some of the financials. Some of those have gotten beaten up too. I would say some of these insurance companies, that sector hasn't gotten beaten up as much. The trends seem to be a little bit more stable. But some of the big banks and some of the asset management types of firms have taken a hit here. But I still like technology. I don't think the story changes completely. Yeah, it's going to change some with tariffs, and I feel like the whole tariff narrative is almost a little bit of a whack-a-mole in terms of they're on, then they're off, and then they're on over here, and then they're off over there. And so
that should be the title of your next blog.
Yeah, maybe. And actually, I actually used AI to put this together. What it is it is a word cloud. You can see here, this is me going to ChatGPT, and I did this with Grok as well. And it's saying, tell me all of the things, the words that get repeated the most. These are like earnings conference calls, every time the CEO is speaking. What are asset management firms, investment firms saying? And we remove like commonly used words like growth, profits, revenue. These are common words that are always going to be used. But, these are the words that pop out the most as uncertainty, volatility, consumer, recession, concerns. I mean, you can see it there. And so I think your original question was kind of looking at styles and sectors and like, yeah, I still like technology and I still like financials, but I think we just have to be a little bit more selective. I mean, this is still very much a just because of the dispersion of the returns between some companies and other companies, it's kind of a stock picker's market right now.
So I'll confess, and I don't know if you remember, but on our very first episode, we had Dan Ives as a welcome guest. But I stuck my neck out and I went up against him, and I was pressing about toppiness in the semiconductors. And I would say at this stage, the pendulum has swung completely in the opposite direction. So much so that I actually bought some semiconductors for the first time as a
Yeah,
standalone
there you
trade.
go.
And I don't know what the precise catalyst and it will be to stop the bloodshed and unlock the value that has kind of reopened in the space. Like I say, you never really, like, we're pretty good, but we're not that good. You're never really too sure what it's going to be. You just, you like the blood in the streets, and like you're showing in your chart, uncertainty, concern, volatility. And to me, historically, that has been the time to buy. Yeah, maybe there's another 5 to 10% down, but I'm less concerned about that. And I'm more concerned about the next 20, 30% up over the next 1 to 3 years, if you know what I'm saying.
Yeah, I know exactly what you're saying. I had a manager years ago. This is, going back 25 years probably. And he made the comment like, we don't know what's going to happen. This is during kind of the tech bubble era. And he just, I remember him saying, we're probably closer to the bottom than we are to the top. So yeah. I feel like that's, kind of what we're going through now. Our top was not that long ago. This has not been a market environment where it's just kind of slowly going down like every 22 week. It's been pretty dramatic, and Sarah, you can remove the chart there if you want. But one of the things that I have noticed, and maybe you've noticed it too, is just the sentiment. Yeah. We have this word cloud about sentiment. This seems like almost as bad or worse than the pandemic or the global financial crisis. It doesn't seem that bad. I mean, we have a drawdown, it's typical that we have a drawdown. We're down like if you look at yesterday's close, I think 14%, somewhere around that area. I mean, this is typical every year. We're going to have, right, on average, a drawdown, but the sentiment feels like this is the worst since the 80s.
Yeah. So I've written about this, and without a doubt, the trade war has taken its toll on sentiment, whether it's consumer, investor, or CEO. I actually wrote about that a week ago. The beatings will continue until morale improves. That makes me chuckle every time I see that or say it. But it's kind of true. So you've got this dichotomy between the soft data, those are the surveys that we just talked about, and the hard data. The hard data are still hanging in there. So there's a big gap, and it gets me back. First of all, I want to say with your word cloud, I love the bearishness, right? Because that kind of gets me going as a contrarian. And we overuse that word, but we like to see the blood in the streets. But whether it's high uncertainty, or volatility, this is the stuff that aligns with major tradable lows in stocks over time. And I mean, you've seen the charts. We've put out the special reports, and I write about it all the time. But I think you're doing the right thing. We want to stay disciplined and really zig when others are zagging. But we brought up the 22 kind of comparison. And I just want to highlight, remember how bad things were back then. We had an everything bear market, and it wasn't short and sharp. It was a slow motion train. Mm-hmm. It was a really bad year. We had a central bank, the Federal Reserve, that embarked on its most intense rate hiking cycle, arguably ever in history. Sure. And you had a recession in earnings. Earnings fell, yet all of that stuff together wasn't enough to break the US economy. And I just want us to kind of, bear that in mind here in 2025. What do you think of all that?
No, I agree. I think the consumers are still in a very, very good position. I guess I worry about when consumers start acting fearful, right? They may say they're fearful, they may say they're worried or they're concerned. When we start seeing that data, that I guess that convergence between the hard data and the soft data,
Right.
if we see that, and I feel like part of this is, not wanting to be political here, but part of it is, some people feel a lot more fearful than other folks do. So that's one element of it. And I think that might skew some of the sentiment figures that we see. I mean, we don't have lots of people dying like we had in COVID.
Yeah.
We don't have the implosion of major banking systems and major companies like we had during the financial crisis. And so like the bad news is just, the tariffs and what's going to happen and how much are consumers going to have to pay. They buy an iPhone. I know there's talk of people that are trying to front run this and get ahead of the tariffs and, buy the iPhone now before, it goes up in price. But, as Talley, I mean, we look at the consumer and what is it? 80% of consumption is service related, 20% being more goods. And then
Is it up to 80 now? Yeah.
Yeah. And then the US makes up like 25% of global GDP, right? So that's a fair amount. I just don't see it being like the very, very worst case scenario that a lot of people are acting like this is like the worst thing. And they're comparing this to like the 1930s.
Yeah.
I don't know. What do you think?
So that's the rumor that I have heard and read about. And we'll get to the kind of the haunting similarities in a second. And I don't want to overdo it, but it's worth talking about just to keep the conversation balanced.
Sure.
But this is kind of the light at the end of the tunnel. So what I'm hearing is the rumor that Trump is also fearful of a depression type of outcome. And so that kind of, I don't know about you, I'll just speak for myself, but it kind of reassures me that there is an awareness there and they are trying to avoid that outcome at all costs. And I would kind of connect that data point to another one, and that was who blinked first. And that surprised me, whether it was going to be the Fed and Powell blinking, they haven't done that, or the administration, Trump. And then we got this 90-day pause on the tariffs. It was almost like calling the bluff. So I like to think that that's the attempt to, test the Trump put and help us avoid that kind of Smoot-Hawley 1930s kind of depression type of outcome. It was a lost decade for the economy. And you really,
Sure.
That was, what was it? But buy the dip, sell the rip kind of environment back then. And, I think that's an outcome people have been preparing for. But what do you think about that?
Yeah, I tell you, I think that the markets just want to kind of know what the playbook is, right? The markets and the economy want to know, like, what are we going to do? None of this, like, we're going to do this today and tomorrow we may, change course on that. So I feel like there's some of that. There's also, I feel, and maybe I would be really interested to hear your take on this, but there's this divergence between the 10-year yield and the dollar. And there's some speculation and worry about, are the Chinese selling U.S. assets? They're selling, U.S. treasuries. And then as that gets, moved back, they're getting out of dollars. They're buying euro, or the Europeans doing that. I feel like there's some worry about that. And you can look at the charts to see that, like, when the dollar weakens, usually yields kind of move in that direction, right? And so we haven't seen it. We haven't seen there, be kind of this correlation between
Right.
The 10-year and what the dollar is. And so what do you think?
I think that, people are concerned that this is the kind of dynamic that you would see in an emerging market. So sell everything, right? Just bail out, whether it's the currency, the equities, or the debt, kind of Argentina style.
Yeah.
And I would say, I think that sell American trade is getting overdone. And there was another concept, and I sent this around internally to the firm. But one of the surveys that I like to watch, global equity investors are the most bearish on U.S. stocks they've been in 30 years.
Wow.
And I thought, ding, 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 spider senses tingling. That kind of smacks of a contrarian opportunity here.
Absolutely.
Not at least tactically, right?
Yeah.
Now, I have to say, in fairness, I did buy international equities for the first time ever in my history. So longer term, I do like that thesis. But in the very near term, and I'm getting at holding period here, tactically, I do think that the sell American trade is getting overdone, and that kind of speaks to that divergence between yields and the dollar. But how are you coming out on that?
Well, I agree. I mean, I just think back to our podcast that we did with Liz Ann Saunders, and she quoted Marty Zweig, one of her mentors, and his what was his favorite tool is Newsweek or Time Magazine, when they say, this is everyone's super bullish, that's probably the time to get out. And when everyone's so bearish, it's the end of the dollar. If you start seeing more headlines like it's the end of the dollar, it's the end of the U.S. exceptionalism, U.S. exceptionalism is dead, like that's probably like a good time to buy U.S. assets. And, we don't know when the bottom is going to be, but, we're in this bottoming process. And you and I talked about this, I think, a couple of weeks ago, that, is it a V or is it a W? Well, now it's looking a little bit more like a W, right?
It's a sloppy bottom. Well, so that's a great question, because you're the CMT on the team. And I want to kind of bring it back to some of the indicators that you're looking at. And I'll frame it this way. So this is not a CMT type question, but I was talking about valuation last week with Adam Parker. And this is one of the annoying questions that I get. It's like a pet peeve. The debate out there about the stock market not hitting bottom until it becomes outright cheap, whatever that means. PE south of 10 times, pick a number. It doesn't really matter. But to me and him, he agreed that the PE's never been a timing tool, and that doesn't really inform too much, at least to us as investors, about returns over the next 1, 3, even 5 years. The coefficient of determination, to get a little dorky, and I can with you because we like to indulge. The R squared is very poor. It's literally zero. So that means we have to, and this is why we have a nice prism or framework to look at. We got to lean on the technicals. What are some of the technical tools that you are seeing here that might be kind of getting us further along in that bottoming process that you mentioned? And I agree, that's the right word to use here, process.
Yeah. So when I'm just looking at technicals, obviously the trend is a mess, right? So the short-term trend doesn't look great. Intermediate doesn't look great. Now, if you zoom out, and so you reminded me the other day, when was that, out in our conference, zoom out. So like we all need to be reminded, I think, occasionally to zoom out. So that, when we zoom out, it's not that bad. When you look at long term, the trend is still, I think, very much intact, but short term, bad. Intermediate, it's not great. And so then you start looking at other things oscillators. Are we looking more oversold? I think we are, right? I like looking at support levels. And so whether it's an absolute support level that we've broken out, that used to be resistance and we broke out above it, now that becomes support if we retest that. And so it's quite possible that we retest the lows that we had. I don't know, what was it, a couple weeks ago when things got kind of dicey and we hit, a little bit below 5,000. So that's possible, but it's support. You can look at Fibonacci levels and they will naturally show you different support levels too. And so I think that's part of that process.
That's part of it. Well, you and I, we talk about breadth in internals pretty much every week. But this is, it's Monday, so we haven't talked yet this week. But what's the S&P 500 breadth looking like? Is it so bad that there's no more sellers? And I'm sorry if I'm putting you on the spot here.
No, you're good.
You know what I mean? Like capitulative kind of seller climax. Do you think we're getting closer to something like that?
Yeah, I mean, we do typically hit these low levels. I mean, it's basically right now it's 25% of the S&P 500. So 3 out of every 4 companies in the S&P 500 is below the 200-day moving average. If you look at the 50-day moving average, it's 15% of the companies. And so not a lot working for the majority of the companies. 85% of the companies are below their 50-day. But if you go back in time again and look at this, this is often coincides with periods where, we are near a bottom, right?
Gotcha.
So
it doesn't have to be zero, right? It could be below. Is there a threshold that you look at?
You know what? Below 25, below 30. I know when you look at the oversold, overbought, it's usually over 70 is overbought, below 30s oversold. And sometimes, and that's not a perfect timing to either, right? Because it doesn't say like everyone's going to get in and buy right now, because it can stay overbought or can stay oversold for a while.
But it works better at the bottom than it does at the top.
It does work better at the bottom because
in
people
the buy zone, right? So that's important.
Yeah, people see that there's just no more incremental sellers. If everyone's bearish, right?
That's
as we see in some of these AAII bullish, bearish spreads,
I love it.
Low number of bulls, high number of bears. You don't have the incremental seller. And so when you don't have an incremental seller, the next person that comes in is going to be a buyer. And then you get more buyers, and then you get people that have done some short, people that have been shorting that need to cover. Then you can almost have a violent move up just as much as a violent move down, like which we've seen that in the last couple of weeks.
Yep. And maybe this is kind of stepping away from the technicals a little bit, but I was thinking about something you said on this conversation about diversification, and it's related to the question that you were asking me about, yields up here just in the past few days, maybe couple weeks. But isn't it fair to say when we look at our models and the more kind of conservative sleeves and the slug, the allocation that they have to bonds year to date? And I'm thinking about the blog that you wrote not that long ago about diversification still being a free lunch. And you had this nice AI generated image of a beautiful spread, right? And it made me want to read the blog because I got hungry just looking at the image. But are we making too much of a deal out of this kind of little tactical divergence between yields and the dollar? When, like we say, when in doubt, zoom out. Aren't bonds, broadly speaking, still kind of performing the role that we want them to in the models and the portfolios?
Yeah, I believe they are, and so and that blog, by the way. That was more of a dinner than a lunch. It should have been more like free dinner. But yeah, I think you're right. And I think this is where, we look at lots of different things on the margin. How can we manage risk? How can we get different types of returns so we're not just correlated to the same types of asset classes? And so exposure to mortgage-backed securities, for example, if the spreads are wider than they are for investment grade corporate, then that's great. Fantastic. We love it. If there's some areas of credit that is asset-backed securities, collateralized loan obligations, and their yield is attractive, and the credit quality is great. I mean, we love it. So super diversified. I don't believe we're overly diversified. That can be an issue if you've got 40 or 50 different managers. Mm-hmm. And they're all doing something different. But then if you blend it together, it just looks like the market. So I believe we are taking some conviction-based, trades with what we're doing to say, hey, look, we want to own, we own consumer staples right now, and we own some real estate and some financials. And so those are positions tilts, if you will, based on research, based on analysis, based on our strategic partnerships that we have with some of the largest firms that are out there, JP Morgan, Goldman Sachs, Invesco, PIMCO, right? And so all of that working together, I think, it still makes sense. And I still believe diversification is, probably more important now than it ever has been. Now, this is like one of those shakeout periods where if people have gotten a little bit complacent, maybe they were just saying, I don't need to diversify. I can just own the Mag 7 and everything's going to be great. Now they're seeing that it's not always great. You do need to have, professional money management looking at your portfolio and a committee and discipline and process. You do need to have that because you just don't know. I think we're also positioned really well when it comes to credit, not having that much credit exposure when, credit is correlated with equities. And so not having that is certainly.
Can I ask you about that?
Actually? Yeah.
So credit is really important. And I'm glad that you said that, because in our special report, I've got this chart showing investment grade credit aligning with U.S. large cap stocks. And, we like to look at credit spreads as kind of canary in the coal mine. And we said U.S. large cap stocks are a tactical buy because the lifeblood of the economy is still flowing, and that's IG credit. But on the small cap side, if I recreated that for the Russell 2000, for example, and I showed high yield spreads, the pressure, further down the cap structure is pretty understandable. But let me ask you from a credit perspective, given the widening that we have seen on the high yield or the below investment grade side, what are you seeing and hearing from our partners? Is high yield credit looking more interesting here?
I think it's starting to look a little bit interesting. It just depends on which part, which sectors, and the specifics of it. Speaking with, I've spoken with a couple different bond managers over the last couple weeks here. Even while on vacation, I was doing a call with one of our partners, a PM out in London, talking about world, sovereign credit, sovereign debt. So I think it really goes back to what part of the yield curve and how high is the credit quality and the duration. All of those things come to play. I will say that most people are still kind of saying that even though spreads have widened some, it's just not worth the risk going all in on credit. If it's a strategic position Now, tactical is different, right? Because we have a tactical model that uses high yield, but we're tactical, and that algorithm said get out, and so we're out. But if you're going to be strategically long-term position in high yield bank loans, we just don't feel like you're getting compensated enough for the risk. Now, if the spreads keep widening and the spreads widen a lot more, I mean, that could be an opportunity that presents itself. Sometimes it doesn't happen when equities have a drawdown. Sometimes it happens earlier. Sometimes it happens later. But that could be an area that we say, hey, look, this has gotten, too wide. And we feel that this is an opportunity for it to tighten. Then you're compensated for the risk. If you're, making 15% yield or something like that, 10% yield, and it's above and beyond what you can get in private credit, and it's, there's full liquidity. Yeah, that might be something that we look at. We're not quite there yet, though. Good question. How about you? I mean, when you're looking at different parts of the globe and you're looking at different asset classes, are there certain things aside from technology and consumer discretionary that like stand out to you that like, hey, look, this looks attractive? And then are there areas that like you think that you would be cautious getting into?
Well, yeah. So, and I put this out a couple of weeks back now, highlighting the gap between consumer sentiment, which, as you mentioned at the top of the conversation, is extremely bombed out, and the performance of consumer discretionary relative to staples. And I questioned, hey, look out below. Things could get worse before they get better. And lo and behold, consumer discretionary has gotten exceptionally punished. But I think it's getting so bad that it could be, if you have a longer time horizon, and I mean 1 year plus. And I know it feels awful. It doesn't make any sense. But if you think about the macro tailwinds here, in amidst all the extreme bearishness surrounding the consumer in the surveys and how everybody's feeling, remember, you've got oil down to what, low 60s?
Yeah.
Bond yields, I know there's been some volatility, but they're not 5%. They're 4.4, and maybe hopefully lower in the weeks ahead. So we've got a couple of gathering macro tailwinds for the consumer. We also had some good political news on some exemptions from the tariffs for the auto manufacturers. So, at these prices, shop the sales. It's the Templeton gospel. So I put on a modest overweight on consumer discretionary amidst all the bloodshed. What do you think? Am I crazy?
No. Well, so I feel like when I take off my technical hat, that is more like just looking at the technicals, you have to look at both sides. You have to look at mean reversion. You have to look at momentum. I like them both. I mean, sometimes momentum is working really, really well. You want to ride that wave as long as you can, but understanding that we will have mean reversion. And when things do look so beaten up, if the fundamentals are still good, if you look at the cash flows, they're still good. You look at revenue and profits. Yeah, maybe people do pare back. But let me ask you, whether it's something like an Amazon or a Walmart or Costco, I mean, you pick any company, retailer that's out there, even if the consumer cuts back some, isn't that mostly priced in for some of these companies? Or do we still have, I feel like we might still have a little bit, another leg down, but we're closer to the bottom than we are to the top. Technically, it doesn't look good, but you need to see that. You will see eventually that trend reversal, things start bottoming and then a reversal some people
Yeah.
like to look at that and say, well, I want to get in once it's already reversed.
Right.
But like, you're never going to time this thing exactly right when it hits the bottom.
No,
So
and
you're going to get in a little bit early, or you're going to get in a little bit late.
Yeah.
Right.
And I tend to be early. So, maybe we'll be better as a team. But you raise a really interesting philosophical theme, and it kind of gets me back to, maybe this is a nice way to put a bow on it, but it gets me back to the doomsday scenario that Trump is an industrialist and he's risking killing the golden goose, and that is the US consumer. And in the process, taking us back 50 or 100 years in our economic continuum, right? Back to the industrial times of, I guess in their golden era of 1970 or whatever. And the way you do that, of course, is by raising costs, raising taxes. That's in the form of tariffs, and they are a tax, lowering standard of living, inducing an everything bear market, and making everybody feel poor and not wanting to spend anymore. I think he understands that would be the Great Depression kind of outcome. And let's not forget the trade deficit is a byproduct of our high class issue as a wealthy nation. It's not a bad thing. It's a good thing, right?
Yeah.
Our growth model is a consumption model. It's not an export model, right? That's China's model. And at some point, they'll come along their growth curve enough where they'll price themselves out of the market, and they'll be a rich, and they're coming along, they're not too close behind, wealthy nation of consumers, and it'll be someone else's turn. So I think that given the people that Trump has surrounded himself and that team, someone there is telling him, look, I don't think we should be going down that path. But what do you, I'll give you the last word, Jim. What do you think on that score?
You know what? I don't know exactly what he's thinking. I wish I did. I know he mentioned, when was it, the other day, he said the markets are getting a little yippy. So I feel like, we're still kind of in this yippy phase. I see the dilemma that he has, because we have, what is it, $9 trillion of bonds that are coming due this year that we have to issue new bonds. We have to refinance that. I mean, in a perfect world, he would probably love for rates to be 2.5% on the 10-year and refinance it, but at the same time have the market do well and to renegotiate some trade with different countries. That's a challenge. I think it's a real challenge. And so trying to balance that is going to be challenging. And the last time that the dollar was this weak, the 10-year was 2.2%. So we're like a couple hundred basis points over that. I think that, you're right. He does have some good people around him, Besant and Lutnick, and there's others. Hopefully they can get in his ears that, hey, look, this is what we want. And, we don't want this thing to turn into a whack-a-mole where the market's up 10%, the market's down 5%, and back and forth like that. So I'm still hopeful that things can turn around. I mean, you and I have been saying for a long time that the first half of the year is just going to be nasty. It's all of our eat your vegetables. This isn't going to be fun. We got all of our candy. We got all of our treats. Second half of the year, potential tax cuts, right? But getting through this is going to be a challenge. And I think we'll look back and say, wow, it actually wasn't that bad, even though sentiment was really, really bad. It's, it's not going to be
from your mouth to
bad.
God's ears. Well, maybe we can just agree, and we can all say that the Fed really should cut rates, and that would help, as long as it's not because we're falling into a depression type of economic backdrop.
Yeah, well, and look, I mean, with all of the talk between, well, not talk, but Trump not showing that he's not happy with the Fed, is that going to make the Fed, be a little bit more dovish? I don't know. I think, it would be good. I would agree with you that it's better to be proactive in this type of situation to, cut rates, because as your charts show, the inflation is coming down. And so, oil prices are a lot lower. And if consumers are cutting back, I don't think inflation is going to be as big of an issue as the Fed may be thinking.
Well, I always appreciate our conversations, Jim, and it was nice to just have a one-on-one here for a change.
Yeah, absolutely.
Hers and his, three's company too. Come and dance on our floor. Take a step that is new.